Hey guys, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and author of Australian Real Estate Investing Made Simple. Welcome to today's video on the interest rates. And what I want to cover today is the long-term impact of interest rates on the Australian housing market, where we were in history, where we are likely to be in the future. More importantly, how it's impacting even right down to the building construction costs associated with new properties hitting the market, and also obviously mortgage repayments, and also concerns that you should have as an investor and things you need to be aware of. So welcome to today's video. A bit of a personal disclaimer. Obviously I haven't met you and I'm not going to insult your intelligence, that anything you learn on this video is going to make you any money at all. So anything you do, you need to make sure you get professional advice that's specifically tailored to your set of circumstances and risk profile. Also about my background, I'm a real estate agent. I have a diploma of financial planning, mortgage broking. Most importantly, I'm a property investor myself, and I'm looking at other property investors in Melbourne every day, sourcing properties in the best suburbs, talking to brokers, valuers, lawyers, accountants, interacting with the best in the industry and helping investors move forward with their property portfolios. Now, I've got a very strong mortgage background. I used to be a mortgage broker, as you probably know. I had a mortgage broking company. I had 28 staff, 13 mortgage brokers full-time. I've trained over 100 mortgage brokers. Before then, I was working for NAB in residential lending, and I also worked for Medfin in commercial lending, residential lending, asset finance. In a way, I'm actually biased towards the impact that money and the money supply has on the property market in a way that I can't kind of uncondition myself. So everyone's got a different part of the economy they're focused on. I'll cover that today as well. So it's going to be a very interesting presentation today, and I'm going to go through and unpack a number of interesting topics. By the way, also want to thank you guys for supporting me. If you want to get a copy of my book on finance, just go to bookonfinance.com.au. You get a home study for free as well, and that's $29.95. And also my best-selling book, Real Estate Investing Made Simple. You can go to realestateMadeSimple.com.au. You get a copy of the book, you get a home study as well. I want to thank you guys for making my book #1 multiple times on Amazon and other shops as well. So really thank you. It's a very humbling experience to see your book #1. And there's some instances #1 and #2 and #1 and #3. So it's been an awesome journey. As long as you keep buying them, I'll keep writing them, guys. Thank you very much. Now, let's get into it. Let's talk about the white elephant in the room. You've probably heard this analogy before, the 6 blind men and the elephant. And it's a parable that's been around for centuries, if not eons and thousands of years. And basically what it is, and this is the reason I'm showing you this parable, is because it has a lot to do with the economy and listening to different experts in the various industries and trying to work out what's happening in the property market. So just stay with me here. It all makes sense. The 6 blind men and the elephant parable. The first one happens. So basically 6 blind men were put into a room with an elephant and saying, describe the elephant. What does an elephant look like? The first one happened to put his hand on the elephant's side. He says, well, he said, no, it's all about the beast. He's exactly like a wall. So obviously he's touching the side of the elephant. It's like a wall. The second felt the tusk. My brother, he said, you're mistaken. He's not like a wall. He's round and smooth and sharp. He's more like a spear than anything else. The third happened to take a hold of the elephant's trunk. Both of you are wrong, he said. Anybody who knows anything can see the elephant is like a snake. The fourth reached out his arms and grasped the elephant's legs. Oh no, how blind you are, he said. Very plain to see that he's round like a tree. The fifth was very tall man, and he chanced to take the elephant's ear. The blindness meant to know that the beast is not like any of the things you name, he said. He's exactly like a huge fan. The sixth was very blind, and indeed, more times he could find the elephant at all. At least he sees the animal's tail, hopefully the tail. That's hopefully the tail. Oh, foolish fellows, he cried, surely you've lost your senses. This elephant is nothing like a wall or a spear or a snake or a tree. Rather, or a fan. He's like a rope. So who's right? Obviously, everyone's different. They've got a different interpretation of what's happening. And look, to a large extent, as we're at the bottom of the property cycle, and I'll show you where we are and how you can check all this information for yourself, what you're going to find is that all the experts from various industries are going to be like the 6 blind men explaining what an elephant looks like. So you have the economists talking about the GDP growth, exports of commodities to China. China now is on the brink of bankruptcy. I'm not sure if you've been following, but 6 banks have collapsed in China. All the major developers are starting to collapse. People are doing a run for the banks to get the money out. Also, people have lost deposits, which are life savings in China. Evergrande has collapsed as a building company, which was the biggest builder in China. The others are in trouble as well. And the whole Ponzi scheme is unraveling now within the building industry in China. Jump onto YouTube. There's thousands of videos about this topic. I'm definitely not the expert on the Chinese property market, but because China is going to slow down in the future, and the fast train also has a bit of a problematic thing for China with nearly $1 trillion in costs, and it's not efficient to have such a wide, extensive fast train network across such a country that's still transitioning a lot of people from poppy fields and the rice fields into suburban environments. So you have this situation where China's thirst, I guess, for commodities is going to slow down substantially over the next few years. And so the commodity sector is going to be affected. So the economists will say, well, mining towns are slowing down, different things are happening in the economy, and then they'll basically draw very clear correlations between the economy and property prices. The finance expert will say, well, no, there's a clear correlation between interest rates going up and the property market going down and vice versa. The cheaper the rates are, the more people get into the market because the affordability goes up and it becomes cheaper to own and rent. And then if interest rates go up, affordability goes down, less people buy less properties. Housing industry expert will always argue there's a shortage of houses versus how many migrants are coming into the country. And the Housing Industry Association of Australia always says there's 150,000 or 200,000 or 250,000 houses in deficit in Victoria that we need to produce in order to cater for the growing demand of migrants that are coming in. And that's creating pressure on supply and demand. And obviously that's creating pressure on prices and vice versa. When we shut down the economy like we have in Victoria for 2 years, no migration comes in and the market now is going backwards. And then you can have also people like we'll talk about the migration expert, income demographic expert will talk about income demographics dictating different parts of the market. So for example, during the pandemic, a lot of the markets in Melbourne, especially the southeast and the Bayside, was largely unaffected, and it actually boomed by double digits because people were working in the banking, financial services sector, in the medical sector, and the suburbs have a higher concentration of white-collar workers, and hence the suburbs went up in value, where the western suburbs have a higher concentration of blue-collar workers and factory workers. So those areas went down in value. And then you got the real estate agent, which will talk about location, and how you can value Melbourne based on the distance from water in the city and the school zones, and talk about areas, suburbs that are booming because they're prestigious suburbs versus suburbs that are non-desirable suburbs to live in and they're falling behind. So who's right, who's wrong? And this is the challenge you have, right? You've got this constant, I guess, situation where you have different interpretations from different people, different walks of life. And a lot of these people are very qualified in their own field. The economists, for example, are very equipped with a lot of data, a lot of charts, and they'll make very good arguments of why the market is doing what it's doing. The finance expert also has a lot of access to, charts and data showing you exactly what interest rates are doing. And I'll show you some of those. I'll unpack some of those charts and data today. Real estate agents, RP data, property cycles, etc. So you got to kind of become discerning, and you got to kind of start filtering out different things and put them into priority in the context of what's happening today and in the context of how different things are affecting different parts of the market. Now, let's talk about the fundamentals very quickly of the market. I'm going to do another YouTube video just updating you where we are in the property market. But I want to keep the main thing. Now, what's the main thing? This is the main thing. The main thing is that the market is $9.8 trillion, the real estate market in Australia. You just hit a $10 trillion the previous month. The outstanding mortgage debt is 2.1 trillion. So the first thing you've got to understand about the market, forget about all the white noise and all the propaganda, all the scaremongering, all the Armageddon stories. $10 trillion, 2.1 trillion in mortgages. So the LVR is 21%. So let me ask you, if you had a house with $1 million and 210,000 in mortgages, would you be stressed as a concept? Or 100,000 with $21,000 mortgage? No. Now, the other thing is these mortgages are not evenly spread across all the suburbs. Majority of them are concentrated in the fringe suburbs called the mortgage belt areas. That's why they're called the mortgage belt areas, because they have mortgages. which is all the new house and land estates around the outskirts of the major capital cities. So they've been affected, definitely, and there's more mortgage stress in those suburbs. I've done a lot of YouTube videos about different areas to avoid, and basically you want to avoid areas where there's extreme mortgage stress. The mortgage stress, by definition, is a property where the owner has fallen behind more than 3 months in mortgage repayments. So definitely, not only is it 21% LVR, which is a very low debt to asset ratio, by the way, that means it's 79% paid off, just so you know. So you have an asset, 79% is paid off, and 21% you've got a mortgage, and you've got a line of credit as well for billions of dollars, all right? Billions of dollars of line of credit. So first thing is, what the hell are they talking about? Are they going crazy? No, they haven't. They're just focusing on mathematics that's meaningless, and it has only short-term implications. Okay, if you look at Australian superannuation pool, it's 3.4 trillion. The Australian Stock Exchange is only 2.7 trillion versus 10. Less than a third of the value. And then commercial real estate is 1.2 trillion, okay? So real estate, number one, is very much all paid off in Australia. Forget about this mortgage stress. You know, Sydney's doing more. No, it's all paid off. 21% LVR, okay? The second thing is, and this is very important to understand, the banks will never allow the property market to fail, because if the property market collapses, the banking system collapses. If the banking system collapses, currency collapses, which means you won't be able to buy goods or services, which means we're back to, you know, Lord of the Flies situation, which means survival of the fittest. Forget about the economy and who's who, okay? The powerlifters will take over with weapons. That's why I'm a powerlifter. And I've got a gun license, I've got a pistol license. So forget about this Armageddon, about this mortgage stress. It's all just, you know, in the context of the whole market, at the macro level, these short-term fluctuations are irrelevant, okay? 21% paid off, 79%. So 79% paid off, 21% is the amount of mortgage. It's nothing. It's literally nothing. 57% of our wealth in Australia is locked up in the real estate market. Majority of the market is owner-occupied as well. So it's not a market that's really governed by fear, greed, and speculation like the stock market, okay? People won't run out of their houses and sell them. You have to live somewhere. People are emotionally attached to a house. People don't buy houses for economic gain. They buy it because of emotional aspects of the property or the area, or school zones, or being on the beach or in the mountains, or whatever they're into. Very few people buy properties to live in for the purpose of economic gain. Now, you don't want to lose money, but that's not your primary focus. It's not your primary motivating factor. Think about when you bought your own house. You know, it was all about design, functionality, you know, what rooms you want, what layout you want, all that kind of stuff. It's not about capital growth. You know, capital growth is way down the list of top priorities when you're buying a property. The second thing is the market is cyclical, and stuff is going to happen always, okay? It's never going to be a time over a period of 20 years when nothing happens. Remember, every time something happens, the market goes up and down. So since 1881, we've had stuff happening, okay? Now, let me make a prediction for the next 20 years. Stuff is going to happen. We're going to have recessions. We're going to have wars. We're going to have this, petrol going up, petrol going down, gold going up, gold going down. We're going to have a stock market crash. Surprise, surprise. And then we're going to have a stock market recovery and a bull. It's the same movie playing over and over, guys. It's Groundhog Day, okay? So why isn't everyone so freakingly, you know, impressed and almost like surprised this is happening? Because it's always happened. What would be surprising if nothing was happening, okay? That would be surprising. If we had 20 years of no recessions, no market fluctuations, no cyclical markets, nothing. Everything just went 3% up and, you know, compounded. That would be a surprise. That would be freaking unbelievable. Yeah, we had the recession of 61, the recession of 1970, 1980, 1990, followed by the credit boom. Boom, recession, boom, recession. That's what it is. But you can see there, it's going up because population keeps rising. Population keeps coming in, and God's not making any more land in the right suburbs. So the Australian dwellings, just so you understand, and this is for the last, national values fell by 2% for 3 months to July. Okay, so July is the latest figures we have, which accelerated from minus 0.2 in June. For 12 months, for July. Okay, we're in August now, so we're going to get August data next month in September. Dwelling values in Australia are 8% higher over the past 12 months, down from a cyclical peak of 22.4. So we're 22.4 and now we're 8%. Where's the Armageddon? Where's the bloodbath? Where's the chunks of blood flowing down the street with bricks and mortar in them? I can't see them. Recorded in 12 months to January 22. Most capital cities are now in a decline. Absolutely, we're in the bottom of the property cycle. This is like, hello, we've been there before many times, okay? So if you're looking at where we are, Australia is negative 2% for 3 months to July 22. Regionals are 0.2 because they're always behind in the cycle and there's less volatility. And then combined major capital cities minus 2.6. So you can see there, it's up and down, up and down. Nothing's new, guys. This comes out, this data comes out, and everyone's like, "Wow, my God, it's gonna crash. I'm gonna lose everything." No, you just don't sell. Okay, Australia for the last 12 months to July 22, 8% growth. Regionals did 17. They boomed because during COVID-19, a lot of people went to Bendigo, Shepparton, Ballarat, and coastal towns because they could. They didn't need to go to the city anymore. Capitals, 5.4%. 5.4% positive growth from July 22 to July 21. Is that a market that's going into Armageddon territory? No, it's still positive. So yeah, we're here and now we're about to go into a decline. It will probably hit somewhere here. Now people say 15%, 10. Does it really make a difference? It's just a median price, guys. It's a median price going down. So let me put it into very crystal clear perspective. This is how I see the market. Because I don't know what the media is talking about, okay? I know what they're talking about, they're just wrong. And the problem is these journalists are broke, they've got no properties, and most of these articles are written by people, they've got an arts degree from Monash University. Now, I've got a commerce degree from Monash University. You know what, you used to have a joke between commerce and arts students at Monash University. What did the arts student say to the commerce student at Monash University? Would you like fries with that? They're just running articles, they've got no credibility. January 21 to January 22, Australia residential property went up by 22.4%. Fact. This is RP data, okay? Then we went down. By how much? Well, we lost 3.1% as of last month, okay? Which means, now just think about this. The property market only should do 10%. Ideally, if you're an investor and you're getting a 10% growth in your suburb of choice, you're killing it. That's what the market is. That's the goal of every investor, 10% growth per annum, which means your property doubles every 7.2 years. The property's been growing at 22%, which is like ridiculously high, double what you should be doing. So it's like getting a car. It doesn't matter what the maximum speed of the car is. Most cars shouldn't be driven over 100 k's an hour in inner city areas. Would you agree? Because that's why, unless you go regional, you can hit 120, 130. Like 100 k's is the maximum you should be able to drive a car in suburban areas. And even then, in suburban streets, it should be 80, 60, and even 40. Okay? So imagine you have a car that's doing 224 kilometers per hour, which is really fast. You should be doing 100. And now it's slowing down because it has to eventually slow down. You can't just drive a car in a straight line indefinitely for 224 kilometers per hour. It slows down by 3.1%, which is, by the way, 6.9 kilometers. That means it's going from 224 to 217 kilometers per hour. That's still very fast, okay? Do you see what's happening? So yeah, we're 22% growth and we're down 3.1. Yeah, it's still going really fast. Oh no, it's all crashing. It's bloodbath. Sell your property. No, still going fast. I don't know what data they're looking at. It's ridiculous. Now, definitely, in July 22, you can see all the major capital cities are going down. Melbourne, Sydney, Brisbane, Adelaide, all of them are down. Okay, and if you look at Melbourne and Sydney, for example, 4.7 for Sydney, because obviously it comes from a higher price point, so there's more expensive properties in Sydney, where Melbourne has cheaper properties, so 3.2. So it's just crazy, you know, in terms of what it is. And then you got the Perth, Hobart, Darwin, ACT. They're in different parts of the cycle. They're also negative. Because remember, the market goes up and down, up and down. That's all it does. So So you can see there, and within every major capital city, you have 8 different price points of properties. But really, if you wanted to, you can cut them down into 3. Okay, you've got the lowest 25th percentile, the cheap properties, the middle properties, the most expensive properties. Now, what happens is, when the market sentiment is negative, which it is now, it's as negative as it was during the subprime of 2008. People are negative, interest rates have gone up, we've got pressure on inflation, goods have gone up a lot, services haven't, but goods have gone really high. So people stop spending money, and also the credit scoring algorithms have been adjusted, so people's borrowing capacity has been affected as well. So people are negative. So what happens is the most expensive properties on the market, which are virtually paid off, are taken off the market. So your Turacs, your Brightons, your Mossmans, your Double Bays in Sydney, all those people take those properties off the market, those $6 million houses, $5 million houses, because they're all paid off and they can't get the price that they want for those properties in this market. Now, because they take them off, the median price for the whole suburb shifts to the left. That's why you see the most expensive properties have the highest drops in Melbourne, Sydney, and to a smaller extent in Brisbane, but Brisbane's really a smaller market for those high-end properties. There's no high-end properties in Brisbane. But Melbourne and Sydney, not because they went down in price, the vendor discounting hasn't really changed. They've just been taken off the market, so the volume has shrunk. That's the key, guys. Okay, so what happens is during those cyclical downturns, yes, the median price is lower, not because every property was devalued, it's because the median price shifts to the left because the top end has been taken off the market. Very important distinction, because I'm not seeing any bargains in Melbourne at the moment, nothing. And in fact, a lot of developers are not even developing because of fixed contracts. They don't want the pressure of completing something in 12 months at a loss. So the best developers we're dealing with right now are completely out of the market. They're not building anything. So for those engineering people that want to wait to the bottom of the market, this is the bottom. It's going to get even lower. What are you going to buy now? Are you going to buy, or are you going to sit this one out as well and wait for another 10 years? Just sit it out. Just pay the 60 grand in tax every year. Don't worry about it. You're doing good work. You're contributing to schools, infrastructure spending, roads, the Dan Andrews Fund. It's all good. It's all good. What do I care, right? I've got my properties already. I just don't care. I never have. That's the thing. I never have. Oh, God, I've made so much money in the last 2 years. It's ridiculous. It's just ridiculous. I don't feel guilty, though. I feel like I deserve it, you know? If you look at Maslow's hierarchy of needs theory, where you transcend from like your basic needs, which is your shelter and food and you know, warmth at night, and then you have your relationships, then you got your personal stuff that you don't really need but you want, like cars and watches, and then beyond that you have self-actualization, where you're giving back to charity. I'm still at that accumulation phase because there's a lot of stuff I don't need that I really want to buy. I think I'll be in that Maslow part of the hierarchy for a long time. It's a lot of shit I want to buy that I don't need. Let's look at inflation. What is inflation? Inflation, if you remember Economics 101 in Year 7, is a basket of goods and services measured over 2 periods of time. And the thing about the basket, those goods and services are adjusted based on what current society lives by and what they do. Now, it's not a really good way of measuring life, and in terms of escalating prices, you got to go deeper because, for example, bread is really not even in there anymore, and I eat bread every morning. Okay, I'm not gluten intolerant. I'm gluten tolerant. My stomach tolerates gluten quite fine, and milk solids as well. And I love milk and bread. So there you go. Don't write in that if you're offended by that statement, if you're gluten intolerant. I understand your intolerance. I understand your struggle. I understand it. Houses are also in there, new houses. So how many times do you buy a new house every year? You probably do that once in your lifetime. So is it a really good representation of goods and services the average person uses in Australia? No. If you take out houses, which are nearly 10% of the whole thing, of the whole goods and service basket, inflation isn't really doing 9% at the moment. It's doing closer to 5% if you have to really look at the numbers. But anyway, let's give it to them. They're economists. They know. They've done their courses, right? So definitely if you have inflation, yeah, definitely, it's up. Why is it up? It's up because 6.1%. Why? Because different things. The Ukrainian war has put pressure on petrol and also even timber coming in construction industries. This whole logistic chain has been disrupted because of COVID-19. It's a perfect storm of things that has happened that has put pressure on certain things like petrol, oil, and construction goods and materials in the construction industry, which has a flow-on effect to other industries. It's more expensive even to buy letters, because letters are like 40% petrol, not made out of petrol. If they are, they're from China. Don't eat those. They're really bad for you. Letters grown in Australia, the cost of getting it to the shop, 30-40% of that cost is in fuel, just to get it from the farm to the shop, not to make it. If it's made out of petrol, don't eat the letters. Very bad for you. You've seen those videos on YouTube where the Chinese, they make rice and letters out of plastic? Check out those YouTube videos. Just trust me, just check it out. You won't believe it. It's crazy. So never have lettuce in China. Not a good thing. So if you get a burger in China, no lettuce, no tomatoes. Actually, the meat's bad too. So take the meat out. And the bun, you can't trust the bun because who knows what the flour is made out of. It could be plastic. So just don't have burgers in China, basically. Just stick to rice. But the rice is bad too because you don't know if it's real rice or it's plastic. So in fact, just don't eat anything. You kind of want to bring food with you, eat, and then leave. That's the safest thing. Construction sector contracts for the second month. So this is this is a performance index talking about the construction sector, because I want to talk about things that are relevant to you as an investor. 3 of the 4 construction sectors, housing, commercial, and engineering, were in contraction in July. Activity indexes were higher than in June for the apartments and commercial sectors. House builders reported high interest rates constraining new orders, which fell again in July. So what's happening? Interest rates went up, affordability went down, people bought less property. Absolutely. Interest rates were the main concern for the respondents across all sectors. Labour shortages and delays in supply deliveries continue to inhibit activity. There's a massive labour shortage of skilled tradies at the moment. There's an exodus from the industry. No one wants to do, be on the roof at 45 degrees, and building houses. People want to do apps, TikTok videos, crypto, all that kind of NFTs, and make $1 billion. Yay, bitches, look at me, I'm a billionaire, No one wants to bang hammers anymore and nails and build stuff, it's not cool. So what's happened is this is why we need people from overseas, skilled migrants coming in, building houses and build stuff, because the younger generation in Australia doesn't want to do that anymore. The other thing that's happened is, and this is a huge one, is the cost of construction materials has gone through the roof in a way we've never seen before. And I'll show you some of the breakdowns of what it takes now to build a house. And then there's other factors as well which are affecting the cost of construction. Because of that, the average construction cost of a dwelling in Victoria in the last 12 months has gone up by $96,000. Nearly 100 grand, guys. So think about what's happening, what that means to you as an investor. If it costs now 100 grand to create the same product that it did 12 months ago, obviously it's going to put pressure not only on new stock coming on the market, but new stock is going to influence existing stock on the market as well. So absolutely, building industry output is down. Lower output, meaning lower supply, which is what's happening now in suburbs. There's very low stock on the market, which means more pressure on existing stock and more pressure on new stock coming on the market. So prices are going to go up next year. Absolutely, without any question. So obviously, I'll cover this later on. Commodity prices have gone through the roof. So this is Australian dollars in terms of commodity prices on items. So inflation is definitely up. It is more expensive to buy petrol. It's more expensive to buy goods and services. Just shopping in a basic supermarket is more expensive. Clothing and anything that needs to be imported from overseas. It's just getting more, not only expensive in fuel, but also the logistics of the supply chain has been disrupted and delayed. Ships can't come in. There's been delays with COVID and et cetera, et cetera. But this is nothing new, guys. You can see the as a result of this, consumer confidence is record low, like we've seen during, in the past. And you look, one of the lowest points was during you can't see it here, obviously, because this only goes to 2014. But during the GFC, we had a very low point. You can see that the budget, people kind of confident, and then bang down again, very negative at the moment. Negative people means they spend less money. And as a result, inflation has gone up. Wages haven't really picked up a lot. There's pressure now with the Labor government. They're going to be increasing wages across all different sectors. But really, wages have stagnated for the last 10 years, and inflation has been averaging 3%. So people's buying capacity and power has diminished significantly over the last 10 years, which is also quite interesting. Now, wages will go up, and there will be adjustments made in different sectors. Wages create more pressure on inflation, just so you know. But I think the gap is so wide now that even the increases will happen. I don't think that there'll be significant pressure on inflation. I think they'll be absorbed back into the market. Where inflation really kicks in and why it's so high is because of the cost of construction. So high inflation is blowing up the cost of your build. So for example, you can see there glass and mirrors. This is to build a new house, and this is just literally as 1 month old data, 14.1% more expensive. Plumbing and products, 11.5%. Steel products, 42%. Which is the internal fabrication of the structure. Gas and electrical appliances, 2.8%. So even ovens, dishwashers, hot water systems have gone up in value. Electrical equipment has gone up. Just basic things like connections. Ceramic products, 12.6%. Concrete, 3.4%. I mean, we make a lot of concrete in Australia, obviously. In Gladstone, we have the biggest cement company in Australia, but to get stuff from Gladstone to Victoria, you need ships, you need trucks, you need fuel, right? So once again, fuel prices have created pressure on those prices. Other material products like garage doors, aluminium windows, guttering, 16.2%, timber board and joinery. So the timber frames to build these buildings, 20.6%, and concrete tiles, 7.1%. So what's happened is, this is why inflation is so high, as you've seen on all the other charts, because of this increase in the cost of not services, but goods, and specifically building materials. You know, the building industry in Australia has one of the biggest flow-on effects on the economy, second only to the banking and financial services sector. So for every dollar spent in the building and construction industry, there's a number of dollars that flows over into different sectors of the economy. Not only are there people employed in building, but you have, you know, real estate agents, you have accountants, you have all the tradies involved, all the goods and services you buy and hook up when you settle a property, furniture, new car sales. I mean, it's virtually into every sector. So building houses is very profitable in terms of the economy. And because we've always got this population pressure in Australia and all the major capital cities, we're always doing really well as a nation. This is also from March 2022. You can see there by product, this is increases in prices on building and construction materials. So reinforced steel, 43.5%, steel, 41.5%, beams and timber, 39.2%. You know, bricks 13.9. So you can see there's a lot of pressure on houses, which means why I'm showing you all this information. The reason is because it's going to be more expensive in the future to build the same townhouse, the same house, the same apartment as it is right now. So if you can buy something now that's been built before this happened, there isn't that flow-on effect on prices just as yet. It will happen soon. And when it does happen, I think next year when we go back into recovery, things are going to just take off, especially with migrants coming back into the country. So what we have is, you know, in terms of building snapshot, buildings definitely have been on a decline. So commencements have gone down. Completions and underway construction is still pretty good, and it's record high. So completed, but in the commencements are down because negative sentiment, builders, developers going under, people just don't want to commit to properties right now. So the biggest thing is what's happening in the future. What's my prediction? Well, one of the indicators is shipping congestion has faded massively. So you can see that now we had a peak in congestion and now it's easing off. Now, what do you have on ships? Not services, goods, which means goods will be cheaper in the future. So you can already see, because of all the kind of delays now, supply chains are looking healthier, and supply chains are creating this bottleneck on getting goods and services to end users. And that's creating a lot of price pressure on all these things. Because they're easing, it's just a question of time before inflation is under control and the RBA will not increase rates any further. In fact, if you look at it, the blue line, this is inflation. This is goods and services contributing to inflation over time. You can see that the blue line is goods and the orange line is services. Goods made up majority of the movement. Services virtually haven't shifted. Haircuts, Mechanics, labor to fix your car, accountants, marketing managers, lawyers, people that bill by the hour hasn't changed, right? What's really changed is stuff, the cost of things. But the cost of things now will go back to normal because all the supply chains are recovering slowly. It's getting easier and easier to bring things into the country. So as a result of that, because we had high inflation, which is unsustainable, the only thing the RBA can do is increase interest rates. And interest rates have definitely gone up a lot in the last, this year especially. The RBA has lifted rates to 1.85 in August. The RBA cash rate further 50 basis points in August, taking the cumulative hike since May to 175 basis points. Underlying inflation through June at 4.9 remains well above the board's 2 to 3 target. However, inflation is expected to decline later this year before declining back towards the target range, which will probably be early next year to mid next year. GDP is expected to slow in the coming years. RBA's central forecast of GDP growth is 3.25% in 22, followed by 1.75 in 23 and 24. So what's happened is we had a record low of interest rates, and now because inflation is out of control because of the war in Ukraine, COVID-19, the perfect storm of things that we discussed, inflation went up and interest rates went up to battle inflation. So remember, what happens is we have a fractional reserve lending system in Australia. So basically there's around 10% of real cash in the economy. The rest is just goodwill of banks lending money to each other. The end of each day, each bank has to settle their accounts and be in surplus or in a neutral position. So if they're in deficit, which they normally are, they have to buy money from the overnight money markets, and that rate is regulated by the RBA. When the RBA increases rates, the banks usually increase rates as well because they want to absorb those costs. Because remember, the functioning aspect of a bank is to make profits. So if something is costing you more money, you're going to pass that cost over to consumers. And that's why rates go up with banks. And that's how the government kind of through monetary policy can regulate the economy. And the monetary policy is very powerful because it contracts the money supply and people's ability to borrow money gets reduced and then negative sentiment kicks in. It's a very powerful tool. And like I mentioned to you before, because long-term fixed rates go up and interest rates go up, I'm very biased towards the interest rates because I come from the banking and financial services sector. I'm just one of the 6 blind men trying to explain an elephant to you. But I try to be unbiased. I try as much as I can. So that's why I'm considering all the other factors. But definitely in terms of, what's happening, at the moment, we've seen definitely reduced amounts of mortgages. People are fixing more rates. But the banks are telling you already long-term rates are going to go down and the best indicator of that is if you compare 12-month fixed rate with a 3-year fixed rate. And banks have already come to the party and started to reduce 3 and 5-year fixed rates. But definitely, look, if you look at May 22, when the RBA decided to tighten the money supply by starting to increase rates, have a look what happened. And this is in Brisbane, Melbourne, Sydney, and 5 cities aggregate. Yeah, absolutely. I mean, the value index for the housing market went down. There's no question about it. Like, it's just really been very, very direct. Mortgages versus dwelling prices down as well. It's cyclical. There's no surprises. It's happened before. It happened before on different fronts, not just because of interest rates. It could be the economy, it could be recession, it could be high unemployment. Something triggers it every time and it's the same result. And yeah, the bottom line is this. For the average person out there in Australia, when the interest rates go up, their mortgage repayments go up. So for example, in April 22, you've got a mortgage, let's say for $750, 3.45%, you're paying $3,347 per month. If your rate goes up to 5.2, which is the variable rate, $4,118, you're paying more, $771 per month, $1,000 on a $1 million mortgage and $500 on the $500,000 mortgage. That money could have been used elsewhere to go out to buy other things. Now you've got a budget for that money every month. So you have less spending power, and less spending power creates a contraction in the economy because you're not going out shopping as much. You're now budgeting, you're not going to restaurants, you're not buying clothing, you're not buying all the things that you normally could splash out on because you've got a budget now for your mortgage. And majority of Australians that work have a mortgage. So yeah, it's definitely, there's a flow-on effect instantly on the economy and consumer sentiment. And that's what's happened. Definitely discount variable mortgage rates have the increase. This is of discount variable mortgage rates. There you see official cash rate went up, variable rates went up. Very direct relationship. Interest rates go up, market goes down, interest rates because of borrowing capacity. Not in all sectors, by the way, not in all sectors. Auction clear rates also go down. People are very reactive in the market. Negative news, they just don't buy it, they don't upgrade, they withhold. They don't upgrade cars, they don't upgrade white goods, they don't go to auctions. So one thing, if you want to predict the future, I mean, you can look at the futures exchange market for future cash rate futures implied yield curve. And you can see there, this is the RBA official cash rate. And you can see that the peak of the market will be roughly March 2023. And then it will go down gradually, which I think when inflation will start to go become under control. And also, you're going to see a lot of migrants coming into the country from China, from India to do the university degrees. There'll be skilled migrants coming back because we have this massive shortage of labour. A lot of people are planning already to leave their countries of origin. They're selling up properties as we speak. And next year they'll arrive in Australia. So the market will go back to its normal cyclical nature. Nothing new about it. Remember, in 1990, interest rates were, I mean, it's ridiculous. Benchmark rate from that was 16.75%. The base rate, 17.5%. 17%. I mean, you guys think you've got it tough? Try doing stuff in the 90s. Variable rate was 16%. You can fix your loans for 15.2 years, so 15.25% per year, and 5 years, 15.25. This is, I mean, a challenging environment. We're spoiled as a nation in terms of cheap rates. We're absolutely spoiled, okay? Comparatively speaking, over the last 50 years. So, you know, variable rates, 4%, 3.5, who cares? It's super cheap, guys. Most properties that I'm sourcing are still cash flow positive, and rentals have gone up by 17.9% in Melbourne in the last 6 months. We're still in an amazingly good environment. If you can't make properties work now at 4%, what are you going to do when we hit 7%, which is the average interest rate the last 50 years? You're going to do nothing, sitting on your hands again. They'll double again, with or without you. You got to understand the market's going to double with or without you. It doesn't need your money. There's other money that's going to come in from other countries that will make the market double in value. So you just got to work out, do you want to be part of it? Do you want to watch it just keep going up in value? So where are we in the property cycle? The market goes from the peak of the market down to decline, bottom, and then the growth part of the market. And you can see that there's what happens during decline is the median price shifts to the left because people take the most expensive properties off the top. So then that's why the median price shifts to the left. It doesn't actually mean that every property in the suburb devalues by 15%. So even when the media is saying, I think there'll be a market correction by 15% or 20%, maybe, but that doesn't mean that every property in Bentley will devalue by 20%, okay? Because most people will never sell their properties during the bottom, number one. Number two, the top will be taken off. The $2.5 million house with pools in Bentley will be taken off because they can't get the price they want. And they'll come back when the market readjusts. So there's no bargains during the bottom, guys. It's just wishful thinking. During the bottom, there's no bargains, okay? And the best properties never get sold at the bottom of the market. That's the problem with the whole concept of timing the market, which I keep telling people. You know, so what happens during economic price is the market, the median shifts to the left. If you don't understand the random regression analysis, just go back to your year 8 maths books. It's all in there, guys. So this is what happens when we have, it's called the property clock. Roughly, this is what triggers different economic events, and this is what happens in the market. And it's not the same every time we go around the clock. There's a different narrative every time, slightly different set of circumstances, but it's the same outcome. You have oversupply in the property market, rising interest rates, lower property sales, which is what's happening now, construction decreasing, bottom of the market, prices fall, and this is where everyone screams Armageddon, everything is going to go down to zero. Yeah, all the Americans come out, by the way. Harry Dent comes out, with a new book, The Great Armageddon Bloodbath Ahead. All the experts come out touring Australia, how this is the end of the market, sell your properties, buy gold, buy shares and buy my book. And then when the market recovers, they disappear back into the cubicles, never to be seen, into the next time the market goes around and hits the bottom. Increasing yields, because rentals go up, which we're seeing already, undersupply of rental properties, and this is what you're going to hear at 8 o'clock, rent money is dead money. Why are you making your landlord rich when you too can own a metrical home for $450 a week? And people go, why are you renting? We should just buy a place. Stuff the landlord. People go and buy places. God bless them. Undersupply of rental properties, falling interest rates, rising sales volume, construction increase. Developers go back here. See, developers go bust here, right? And they go, oh, you can make 35% margin now. Back in the game. Rapidly rising prices. This is why I start revaluing all my properties, and I watch the whole thing happen again. It just keeps going around and around. Groundhog Day, guys. Nothing new. Nothing new. Same story. Same old story just playing out. It's just there's a different generation every year that says, wow, this is all new. It's all magic. So where's Melbourne right now? Here, about to go into the bottom. We're going to go down further in prices, absolutely. Does that mean there'll be bargains? No. No. The best properties are off the market. There's no bargains this time, guys. What are you going to do? It's crazy. And this is what you're going to see. These articles come out at the same time. New study find housing affordability in Sydney, Melbourne and LA is worse than New York. All these left-wing academics are going to come out and saying, oh, our children can't get back into the market. No one can afford to buy anything. The young Australians are giving up the property dream, which they've been giving up since 1946, by the way. I've got articles since the 50s saying how it's unaffordable and unattainable. And at the peak, it says, young people never own a house. We ask how they feel about it. Well, how do you feel about it? I don't know. 90% of millennials concerned they won't achieve great Australian dream. The Aussie housing crash then it goes down, and then it's all accelerating, right? And then the rising interest rates could crush the housing market. Millennials aren't mad about it. Bank wants too many interest rate rises could crash the market, and then the property market is stabilizing. It's about to crash, and then it goes up and around again. So this is what the media does: Armageddon bloodbath, right? Your properties will devalue to zero. Recovery. Oh, we can't say that, okay, recovery's happened, so what's the next thing negative? Young people can't get into the market anymore. Let's focus on that negative aspect. Then the property market goes up. Oh, they've lost their dream. They'll never get into the market. There's a whole generation of renters now. Yeah, it's been happening since 1950. Peak of the market, there's no news at all. Now they say maybe, these areas went up by 30%, 40%. And then suddenly, woohoo, the market's going to crash now. We told you. This goes up around. The older you get, guys, the more times you go around the block, the less surprised you are this is all happening. So, and how do we know we are in the property clock? Herring Todd White Value was the biggest valuation in Australia. You can see there, this is for the national property clock for houses. And there's Melbourne there declining, and we've hit here already, in my opinion. And these are the markets that are going into the rise. Doesn't mean that every suburb does this, by the way. It's the general market. Melbourne has 8 distinctive markets, guys. There's no such thing as Melbourne. It's St Albans and Toorak. Okay? There's a property sold in Toorak just the other day for $80 million. Most expensive house ever sold in Melbourne. Okay? And there was another one sold for $76 million. And then you got St Albans, right? 450 to 600,000. So, forget about this timing of the market thing. And what happens is you have the stealth phase is where the smart money comes in at the bottom because the fundamentals never change. Now is the time to buy suburbs that are based on good fundamentals. There's no bargains in them, but the fundamentals have remained the same. It's always a good time to buy in Albert Park, Middle Park, Port Melbourne, St Kilda. Then investors go in during the awareness phase. So stealth phase is what I operate in. Then you have the awareness phase where the whole media is on top of it. Oh, the market's recovered again. And then you have the mania phase where everyone gets in. With every barbecue, everyone's telling you how much the house next door sold for. We can't believe it sold for 100 more. Can you imagine? Blah, blah, blah. That's the disaster area. That's when you don't want to buy properties. That's when you want to revalue your properties and use those references to lock in your lines of credit. Why? Because those references are only valid for 90 days and that's it. After 3 months, they expire. So what you want to do is do counter-cyclical investing. Revalue at the peak, buy at the bottom, based on fundamentals. Then what happens is majority of people get in too late. There's denial, despair, fear, and then the market goes back up again. Same old, same old. This is the property clock around Australia. So if you want to get that information, by the way, just jump onto Heron Todd White Valuer's website, htw.com.au. You can download the Housing Monthly Report. It gives you all the property clocks. This is what they look like. Victoria is here. And then, by the way, you have inner suburbs, metropolitan and regional. So the blue is inner suburbs, which is what we want as investors. Metropolitan is this one, which is the further out suburbs. And then you got regional as well. So you can see there the blue hand is in different parts of every major capital city because some parts, they're counter-cyclical to each other. So there's different clocks obviously operating within every major capital city. Faster rate of decline in earlier downturns. So yeah, we went faster down because we had war in Ukraine and different things disrupting the economy and COVID-19. But really, there's nothing new to see here, guys. It's always a question of a glass half full or not full enough. So I just take the water and drink it. I don't care. It's always about opportunities. Remember, the best opportunities are always disguised as problems, always. And you just drink the glass. If the market's down, you buy properties based on fundamentals. You might better get a good deal. Not always, but you might. There's no bargains at the moment. There's no discounting, which people, maybe there will be in the future, but does it make any difference at all? No, it doesn't. Remember, 95% of people are reactive. They react. They get blown around with the media like a paper bag in the wind. 5% respond. And the difference is your level of awareness. And you choose either way by default because inaction is also, not taking action is as consequential as taking the wrong action. Sitting on the fence line and watching the market play out is not taking action. That's reaction. You're reacting by not taking action, okay? If you could invest, if you have the capacity to invest because you're paralyzed and you don't know what to do. Responding is knowing exactly what to do. Investing is about taking educated guesstimates and gambles based on knowledge and making money. That's all it is. There's always an element of unknown. Smartest investors are buying properties now, revaluing at the peak. That's all they're doing. Remember, be fearful when others are greedy. Be greedy when others are fearful. Do the exact opposite of what everyone's doing, guys, because everyone gets it wrong all the time. Dollar cost averaging, that's all I do. People say, what's your secret? Well, it's very simple, but if I tell you, you're not going to do it. Well, tell me. I just buy properties whenever I can buy properties. Oh, just like I do powerlifting whenever I can do powerlifting. Oh, is that it? Yes. If I can train 5 days a week, I go 5 days. If I feel sore one day, I just don't train that day. I go back the next day. That's it. 25 years later, guess what? Went from 72 kilos, 6'2", to 140 kilos. Not by miracle, by design. Same with my portfolio, dollar cost averaging. You buy always and you end up getting a really good price. Sometimes you overpay, sometimes you underpay, sometimes you hit market. Long term, the fundamentals don't change. Dollar cost averaging. That's all you do. So I hope you enjoyed the video. If you want to learn more, I'll be coming back with new live events that I'll be doing soon. Remember, there's 4 types of investors out there. There's the analytical compulsive information gatherer. They do nothing. They get all the information. They sit on it. They're inactive. There's the get-rich-quick gambler, which scares me. These people would just want to jump into anything that makes them millions of dollars instantly. Not good for the property market. It's very slow. Get rich very slow, okay? The comfort zone investor, which is the average mum and dad in Australia. 72% of investors only own one property within 3 or 4 k's where they live. They live in a 4-bedroom house in Moorabbin. They buy another 4-bedroom house in Moorabbin. That's it. They never go to number 2. And then there's the active, savvy, educated property investor, which is what you want to be. And if you're one of those people, feel free to book in a 60-minute free consultation with me on Zoom. I can go through your situation, work out where you are, where you want to be, give you some feedback. Developing a plan is the most important thing you can do in your journey to financial freedom. Plans are everything. If you fail to plan, you plan to fail. Most people waste so much time in their life doing this, going from A to B, trying out all these different methods, where they just could have done this. Then remember, you can always get more money, you can't get more time. Time is a non-renewable asset that's always running out, and eventually you're going to run out of time. At 65, guys, it's very difficult to borrow money. Very difficult. You've only got till 65 to build up your property portfolio. And not only from a physical perspective, but I'm talking from a purely financial perspective. The banks don't want to know you after 65, okay? They'll never say that to you. They'll be on current affairs. They're already on current affairs, but there'll be another thing to add to them, okay? Not very popular in Australia, the banks are. So you get a 1 hour consultation. I'll find out where you are, where you want to be. I'll do a personalized strategy, give you some feedback about how to get from A to B with the least amount of effort, maximum results. I'll introduce you to my whole team of experts, solicitors, accountants, mortgage specialists, the whole team, which will help you to get from A to B. And just for that introduction, it's worth it, guys, because the key to success is to surround yourself with people that are exceptional at what they do and leverage off their skills and experience. You walk away with a real strategy, a real tangible strategy of how to get market ready, or what properties, if you might be market ready already, so what properties you can target, what they'll look like, cash flow analysis, a 10-year plan of replacing your income. It's a step-by-step, paint by the numbers. Literally, it is so easy once you see how it's possible to build wealth. To qualify is very simple. You have to have the ability to borrow money. If you don't, you really don't want to see me because I can't help you. Because guess what? Investing in property means you have to borrow money. So you got to have at least ability to borrow $700,000. As an individual, you need to be on $95,000 per year and have access to $112,000 in equity cash or available equity from somewhere. It could be a rich uncle somewhere overseas or your parents. The bank of mum and dad is very popular with the young generation. If you're a couple, you need to be on 80 and 40 and 60 grand, so about 140 grand combined income with 112,000 in equity. So you can put a 10% deposit down and cover the stamp duty and legals, and you can transact on the first property. As long as you can get to the first property, I can get you to the second, third, fourth property and thereabouts. If you can't get the first one, you can't get started, okay? It's impossible without the first one, okay? I hope that makes sense. So it's like joining a gym but not joining a gym, okay? You're not going to get any results. Or you can sign up, but you can't go inside the gym. So definitely, for those who've been to a live event, you have this form, just tick the box, send it to me. For those who haven't been to a live event, just watching a YouTube video, just email me directly, Konrad@investorsprime.com.au, and just headline free consultation request and just your name and your mobile number and email, obviously, and I'll be in contact with you. You don't need to put any reasons in there or write any essays about yourself. Not necessary. So I'll just reply and book you in. I am getting booked out a lot, so there's a bit of a waiting period, but I'm definitely keen to see new clients. I love helping people build up their wealth. I've got amazing stories. I'm writing a book about case studies, and I've seen people go from 0 to 5, 6, 7 properties. It's amazing. See their lives transform. It's just such a satisfying experience that you know that you're the conduit for their lives to change. And people have gone off and done different things and set up businesses and quit their jobs. So stay tuned in the future for some really interesting books that I'm going to be writing about these case studies. That's it for me, guys. I hope you enjoyed this YouTube video. This is Konrad Bobilak. I'll see you on the inside.